and welcome to our special coverage of TCS's Q2 earnings straight from the TCS headquarters. TCS is reporting its Q2 numbers. Prima facie, there is a beat on margins. Margins have gone up by 90 basis points on a quarter-on-quarter basis, coming in ahead of expectations. TCS EBIT margins at 24% is a slight beat compared to consensus expectation. This beat on the margins is driving a beat on the profitability as well. So consolidated profits at 10,431 crore are higher than our expectations of 10,250 crore. That's an increase of close to about 10% on a quarter-on-quarter basis. Rupee revenues, which have got the support of the currency depreciation that we've seen in the quarter, have also seen an increase of 4.8%. These are the numbers that we currently have right now from TCS. A margin beat driving a 10% increase in the company's revenues. Awaiting some more clarity in terms, dollar revenue growth has come in at 1.2% on a quarter-on-quarter basis. This is in line with street expectations. The order book for the company has come in at $8.1 billion, slightly lower than the $8.2 billion that we saw in the prior quarter, but it's still within the company's guided band of order wins being in the range of $7 to $9 billion. The company says the order book in UK and Europe is stronger in Q2 versus Q1. So that is contrary to street expectations, which believe that perhaps things would start slowing down in UK as well as Europe, given the weakness that we've seen in the economy, the gas price pressures, inflation, etc. But at least as of now, despite the deteriorating macro conditions, the volatile macro, demand for TCS and its performance has remained fairly resilient. You would say the performance of Q2 has been in line with expectations, a dollar revenue growth of 1.2% in line, and margins too have expanded like the street was anticipating by 90 basis points to 24%. So no reason for the street to be disappointed by TCS's numbers, and I guess the street perhaps got a whiff of these numbers because the stock did see a pretty good intraday recovery in trade today, with the stock price ending higher by close to about 1.5%. We have Prakash Diwan also joining us on the show now to give us his thoughts on the numbers. Prakash, thanks so much for joining in. Could you quickly tell us what is your key reading from TCS's numbers?
So, pretty heartening to see that things aren't as difficult or as bad as what was anticipated. And as you rightly said, this is far better than that 102, 103 billion PAT, which was kind of being expected. It's definitely a mild beat on that. And in the given environment, any beat is good enough, right? So my sense is, the peaking out of all the cost increases in Q1 seems to be the factor. And Q2 is kind of, very clearly leading to that improvement in margins. Interestingly, this has happened where most FIs have actually exited most of these large counters, particularly Infosys and TCS as well. Which was almost like a death knell for the sector, where people thought that this is time to get out, and it'll probably go into a little bit of a slowdown that can only get precipitous. But things seem to be far more resilient. So if there's any downward pressure, Reema, that could probably be felt only in subsequent quarters. And of course, Q3 is generally the one where you have a little bit of weakness in terms of, furloughs and all of that coming in. But I think it's pretty heartening to see the revenue getting clocked decently, in all the geographies, hopefully, as we hear the commentary. Importantly, I would want to understand whether there's anything that's particularly helped in this quarter, or whether there's something which is more like a factor that you could build into a trend. But definitely very, very positive. And as you said, probably markets went into earnings with very mild expectation, except for the couple of hours in trading session on Monday. So that's where it's held.
Okay, there is a beat on constant currency. So the company's constant currency revenues have gone up by 4%, much higher than street expectations, which were about 3.4, 3.5%. It's also better than the company's Q1 performance. So growth has been very solid for TCS this time, contrary to expectations, where the fear was that perhaps we'll see some signs of slowdown. Q2, remember, is the typically strong quarter, but at 4%, it is a revenue beat. There is a slight margin beat as well. So the street is definitely going to like the numbers. A few internals which look a bit subdued. One is attrition. Attrition for the company has gone up to 21.5%, much higher than 19.7% in the prior quarter. This is the last 12 months attrition, which basically takes the average of the last 4 quarters. So even if this quarter or in the last month we've seen a dip in attrition, it doesn't get reflected in the last 12-month attrition. But the LTM at 12.5% does suggest that the supply side situation continues to remain tight. The second internal that is not great is the hiring. So the net increase in the headcount is sub 10,000. This compares with 14,000 of hiring, the net increase in Q1, which compares with 25,000 as an average in FY22 on a quarterly basis. So there is a sharp drop-off in the net increase. One of it perhaps is to do with the high attrition, and maybe the company did not find enough employees to backfill that attrition. But the net addition in terms of employees at 9,840 will come in as a bit of a disappointment, because the street, there will be a part of the street which will read it as a proxy for future growth. Is the company hiring less today because they anticipate demand to drop off in FY24? That is going to be a question. Let me quickly try and read out the statements that are coming in from the management. Rajesh Gopinathan, who is the CEO and MD of TCS, says the demand for our services continues to be very strong. We've registered strong, profitable growth across industry verticals in all our major markets. Our order book is holding up well with a healthy mix of growth and transformation initiatives, cloud migration, outsourcing engagement. As clients prepare for a more challenging environment ahead, technologies like cloud that have been embraced now have to be fully leveraged to realize the promised value. TCS has a combination contextual knowledge, technology expertise, and the execution rigor to deliver on this imperative. So in a way, he's quite confident that even if the operating environment is tough, TCS will continue to gain market share given its expertise in cost takeout deals as well as growth transformation initiatives. So the body language from Rajesh Gopinathan continues to be very solid. Another statement coming in from NGS, N. Ganapathy Subramaniam, who is the COO and Executive Director of TCS. He says this was another excellent quarter of execution that saw us delivering several transformation projects, like the largest migration of 2.3 million policies at the TCS insurance platform in one go in the UK, or the trading platform at the Gift City. Samir Saksaria is, okay, let me read out. This seems to be a more important one. Samir Saksaria, the CFO, says we are steadily making our way towards achieving our operating margin priority for the year, aided by leverage from good growth, flattening of the workforce pyramid, steadily improving productivity, and currency support. He says headwinds from supply side challenges are abating, and that sets up well for the seasonally second half of the year. This is a very strong statement coming in from Samir Saksaria, the CFO, where they are talking about making higher margins a priority for the company. They see margins expanding clearly from here on, given the currency support, the flattening of the pyramid, and they're also saying the supply side challenges are abating, and that sets the company up very well. So the body language from the CFO seems to suggest that margin expansion is likely to continue. So all in all, the key takeaway is TCS's Q2 has delivered on expectations, in fact beaten them. Constant currency revenue growth of 4% ahead of expectations. EBIT margins have expanded by 90 basis points to 24%. Again, higher than expectations of 23.8%, so surpassing expectation there. The currency lending its support to the margins. There is a big impact of cross-currency. The cross-currency headwind stands at 290 basis points because the dollar revenue growth is just at 1.2%, while the constant currency revenue growth is close to about 4%. But that said, TCS has delivered and met street expectations in Q2. It's a strong quarter compared to the street's muted expectations. The management commentary is also fairly resilient, both from Rajesh Gopinathan, NGS, as well as CFO. Let's get in some more reactions. Omkar Tanksale is now joining in. Omkar, will these numbers from TCS allay any worries that the street had about slowing demand?
Yes, I mean, definitely, but I believe the TCS has reported largely in line results with the street expectations. The only concern about me is the attrition level. We were expecting some plateau or, at flattened down at some level, which has not been, it's been still rising at 1.5 for the quarter. that it shows and there is still volatility is going up. But I mean, on the demonstration part or execution part, they have demonstrated well with the margin expansion of 3 basis points for the quarter, which is ahead of our expectations. That's demonstrating a strong execution. I think we should be just listen to the commentary from the management. However, the management are still very bullish on the spendings from the large client accounts currently. But like to be have the words or listen to the commentary is going ahead.
Prakash, what did you make of the statements from the TCS top management?
No, I think all three versions of the input or insight into this earnings are very positive, and of course it might not be as bullish as what Rajesh Gopinathan sounded in the same quarter of 2020 when things actually took off from where the stock actually rallied so hard. But what's interesting is since you were talking with the internals after we spoke on the first reaction, if attrition at 21.5% can probably be the peak, and why I say that is because they're hiring the sub 10,000 number very clearly gives you an idea that probably they're anticipating attrition to only taper off from here. And if that were to happen, you already have a constant currency growth which is phenomenal in the current environment, the volatile environment that you see. Margins getting retained. And their focus on margins that NGS is talking about is so positive for the simple reason that they probably amongst the big players, they have reached a scale which they don't need to be worried about in terms of market share gains and this thing. And some of the new projects that they've undertaken, it could be small ones like the BSNL revival and all of those are great learning experiences. So my sense is this is probably a change, a shift in gears for TCS in a territory or in an environment which was tougher, and they'll probably not only be resilient to all the vagaries of the slowdown that is anticipated, but they'll probably strike out the perfect balance in terms of growth and margin. So I think from that perspective, the stock offers great opportunities. This earning just endorses the fact that good companies always come back, right, in tough times. So this actually reflects that, and the statements validate that view if you had. So my expectation is that things could only look up from here, given that some of those worrisome parameters in terms of costs and attrition are probably peaking out and are behind us.
Well, the question is, will it convince the bears on the street who believe that FY23 numbers are going to look steady and strong because it's a reflection of the deals won in the prior quarter? But come January, the budgets for next year are going to be set. And at that time, we are likely to see some tech budget cuts, given the recessionary environment in developed economies. A lot of clients, enterprises have been hit on account of inflation as well as slowdown. So tech budgets could get hit, which will then result in slower revenue growth in the subsequent years. So, these numbers are good, but will it convince the bears on the street that, I guess over the medium term, we will have some, clarity as well as from the management when they address the press conference at 5:30 p.m. Moshe Katri is also with us from Wedbush. Moshe, thank you very much. What would be your top 3 takeaways from TCS's earnings this time?
Hey, good to be here. So I would say better than feared numbers. I would say that demand continues to be solid despite the macro volatility, and that was kind of expected based on the recent surveys that we've been conducting. And then third, I pretty much concur with your opinion, Reema, that it's less about the quarter and it's more about budgets for next year. So I don't know if budgets are going to be cut next year, but I think you'll probably see some sort of a slippage in budgets, which means that rather than budgets being ready by, I don't know, sometime in January, maybe you'll get a slippage by a month or two, which means that you're probably going to get a back-end loaded year in terms of revenue contributions for the sector. But, so far, so good. Budgets are already set for this year, so we're assuming numbers will track in line with expectations. But the real question continues to be calendar 23 budgets.
Absolutely. Moshe, deal wins at $8.1 billion, similar to the deal wins of the prior quarter and within the company's guided band of $7 to $9 billion. Would the deal wins already start reflecting if the macros are deteriorating? shouldn't that be read as a proxy for future growth? And if deal wins are holding up, that means perhaps the next year may not be as bad. How would you read the deal wins and its significance?
Deal wins can be a bit tricky, Reema, just because we don't know how much of the TCV is new logos versus renewals. So that's number one. Number two, the rule of thumb in our industry is that budgets are not engraved in stone. So, you can win a deal, but it doesn't mean that you can get funding for it next year. So I'm always kind of skeptic when I see the TCV numbers. It's always good to see kind of an uptick in terms of directionally where they are. More on new logos versus renewals. I don't know if that means much.
Okay, just one more word. How would you read the increase in headcount? At 9,840 increase, it's much lower than the quarterly increase that we had in FY22, which was about 25,000. There is a sharp drop-off. Either it means that the company anticipates a slowdown in demand, which is why they're going slow on, replenishing the bench as, attrition continues to remain high or make fresh hires, or it means that attrition they expect is going to drop off significantly and therefore they don't need to make these hires. How would you read this number of increase in headcount?
The word is flexibility. Accenture also had a smaller than expected hire number for the quarter. And you'll see many companies getting set up and getting ready for that potential slowdown that everybody's been worried about. You want to get that flexibility on your bench. You want to make sure that your costs are under control because of that macro. And if demand remains where it is, they can always go back and start rehiring. So I think the word is flexibility.
Okay, but the statements from Milind Lakha, the chief HR, has said, we believe our quarterly annualized attrition has peaked in Q2. This is the first time they've put it out in a press conference, in the press release, saying that the quarterly attrition has peaked out in Q2 and it will start tapering down from this moment, while our compensation expectations of experienced professionals also moderate. So at least on the supply side, commentary in terms of attrition, in terms of perhaps what the wage bill is going to be as they hire laterals, is also fairly moderate and positive from a margin point of view. The company categorically saying that attrition has peaked out. It will start reflecting and moderating from this point on. They had said it even in the prior quarter. They said that their quarterly the attrition will increase in Q2, and then come down in Q3 and Q4. But the management reiterating that. They're also saying compensation expectations of experienced professionals has moderated. So that's also an important indicator of what the wage hikes is going to be, or the compensation on the variable pay is going to be. Samir, one more word on margins, because Samir Seksaria, the CFO's statements on margins do seem to indicate that the company is focusing a lot on margin improvement, right? On the supply side, things are improving. They've got operating leverage. They've got the support coming in from currency as well. Would you look to increase your EPS estimates, baking in higher margins than what you earlier anticipated, driving an EPS upgrade for TCS? Moshe?
Yes. So a couple of things about earnings and earnings power and leverage in the model. Reema, if you remember, during the last downturn, companies in the space exited the downturn with peak EBIT margins. And a lot of this has to do with cost control, with bench management, if you will. But ultimately, you're going to have to maintain a balance between how many people you want to retain on your bench versus the possibility that things will pick up after a downturn. So there's no doubt that these companies have leverage in their model. They can maintain and sustain margins even throughout a downturn, but you have to maintain that balance. Just because when demand picks up, you have to have the right capacity to be able to kind of go ahead and process the demand or the pipeline. So that's kind of where we are right now. You can manage the bench, you can manage margins, and there's no doubt about that. And look at the margin levels that a lot of the companies had at the peak or when we exited the last downturn.
Okay, Moshe, thank you very much for your inputs and reacting to the TCS numbers. We also have got Omkar Tanksale with us. Omkar, we had got you on a bit of a scratchy line, but you've had more time to go through the TCS numbers. If you could provide us your insights, what stands out for you?
Yeah, I mean, I've my reading about the TCS numbers. I mean, the TCS has demonstrated the resilience of the business despite of the uncertainties going on. So, and also shows a resilience about $8 million deals that they have closed for this quarter. We were expecting around 8 to 8.5. I mean, there will be definitely a slowdown because of the uncertainties and slowdown in the world's largest economies. But I believe the slowdown must be at the growth momentum that they were picked by FY21 and FY22 currently. But I believe the business is still being resilient and will likely to demonstrate strong. Continue to be demonstrated the growth in the forthcoming quarters. We also believe that the attrition level or the supply side constraint will likely to be managed because of the slowing down on the demand side, because of there is a large demand for the technical experts and coders and especially on the digital front, the cloud transformation vertical, like various services like HANA, data security, cyber security, etc. But likely to be settling down going ahead, which will benefit these companies to manage their employee cost and other operating costs as well. With the growing volumes, the company will likely to get a larger, the stability of the margin side we're going ahead.
Prakash, one final word. What's the read-through for the rest of the IT pack?
So, it's difficult to extrapolate what metrics TCS ends up reporting to the rest of the pack because all of them are going through their own set of challenges. But, given the fact that the commentary on demand seems to be benign, I would believe that you'll probably not have ugly shocks in most earnings, maybe except for, some of them like HCL Tech, which probably are a bit more vulnerable given their mix of revenue. But other than that, I think most of them will end up doing much better, given that the execution of the order book for this particular year could go on unhindered, more or so for the next 2 quarters as well. So that anticipation is kind of building in. It'll be interesting to see as a read-through for other companies, especially the larger ones, which have been a bit more margin conscious, like Infosys and all, in terms of how they respond to attrition and the challenges on the supply side. So I think this will set a little bit of a expectation which is more positive than what we had, let's say, a week back from IT. And then there were some reports which actually pulled the whole house down. As a sector, there was so much of downgrades that it kind of got worrisome. But this looks like, it's probably not yet a scenario of tough times for the numbers, at least, to reflect, and hence the stock could get to live for another day and start bouncing back with some sort of buying coming in. And particularly for TCS, I think these numbers will definitely attract a little bit of comeback of sorts in terms of whatever FI outflows we've seen in the recent quarters.
Prakash, Omkar, Moshe, thank you very much for joining in. A quick wrap out of TCS's numbers. Well, TCS has delivered a good Q2 earnings. Constant currency revenue growth at 4.4%, higher than consensus expectations of about 3.5%. Margins expanding by 90 basis points, aided by operating leverage. Currency surpassing expectations. The bottom line, the profits for TCS have crossed the 10,000 mark for the first time ever. That too, growing by 10% is ahead of consensus expectations. A couple of the other important internals, deal wins largely steady at $8.1 billion. So that's a positive. However, on the supply side, the net hiring for the company has come down to sub 10,000 and attrition has increased to more than 21%. The management commentary is fairly upbeat. They say that even though the clients are preparing for a challenging operating environment, the body language from TCS appears to be that they continue to be fairly confident about the relevance of their TCS's service. So in that context, they don't appear to be too perturbed. Samir Seksaria, the CFO of the company, is saying that their priority is on margins, and I think the the hint is that margins could continue to expand from here on, while the HR head is talking about attrition having bottomed out or peaked out, in Q2. Well, it's a good set of earnings. Despite a difficult operating environment, TCS has not seen any business impact, and things in Q2 at least have been fairly rosy for the company. Thank you for watching this special coverage. We'll come back and get you, we'll get you the coverage from the TCS press conference as well.